here with our guest. Let's get out of shell. Let's find out what Rogge Horner has to say.
It always makes me smile to see you three. How you guys doing?
Man, this lady is most complimentary lady on Wall Street, and then right back at you, Rogge. Dennis has something that's sticking in his craw, so I'm going to let him present it to you ahead of the PPI information.
Yeah, so one thing that I ran across, and one of my followers, Andrew, thank you so much for sending me this on Twitter, and I talked about this. I wanted to bring Rogge into this conversation as well here. I've been talking about shrinkflation here, Rogge, and I don't know if you noticed, but when you go into your stores, the products over the years seem to have gotten smaller. So I think, we're safe to say that shrinkflation is a real thing. So I was talking about this on the show a couple days ago, and a follower, I didn't know if the CPI captured this. A follower sent me this, Andrew, sent me this great article here, which you can tweet out or follow the link if you want. It's in my Twitter here, but it's from the U.S. Bureau of Labor Statistics. And the title of the article is Getting Less for the Same Price, Explore How the CPI Measures Shrinkflation and its Impact on Inflation. So the CPI does indeed calculate shrinkflation into the numbers. That's comforting until I get to their conclusion, Rogge. And do you want to know what they estimate? In chat, we can throw it out there too. What they estimate the annual shrinkflation rate is and its effect on the CPI. What do they estimate it to be? Take a wild guess. Shrinkflation. What does the U.S. Bureau of Labor Statistics calculate the shrinkflation effects into the CPI? Take a wild guess. How much percent?
I'm sitting down. I'm ready. I'm sitting down. I'm bracing myself. Hit me.
Yeah, you don't want to take a guess?
Yes, come on, Rogge.
Joel guessed 2%. That shrinkflation is probably 2%.
Oh, I was thinking 2 to 3 times that.
You were thinking 5 or 6%.
I was.
Do you know what they calculated in the CPI? How much it's been annually, an annual effect? 0.01%.
On Earth?
On Earth, exactly. 1/100th of a percent. So that means, let's give this perspective, that the size of your chocolate bar will go down 1% every 100 years, according to the CPI statistics. So now I challenge everything that they do. If this is what they are calculating as shrinkflation, Rogge, if this is what they are calculating, 0.01%, they are either not very good at their jobs or they are flat out lying to us, because this is an unbelievably ridiculous conclusion. I talked about the sunscreen going up 20% last week from shrinkflation. 0.01% is an absolute joke. Whatever you're doing, Department of Labor Statistics, to calculate shrinkflation, do it another way, because we're not stupid. Our products are not falling in size 0.01% a year. What are your thoughts here? Now I just challenge everything they do in the CPI. And obviously, we had a CPI number yesterday, so I wanted to bring this all in the conversation here, Rogge. But I just fed you a lot of information here. I mean, we see CPI falling. Are they lying to us about CPI falling? I'm scared now that I see a statistic like this.
One, I should have put a little Bailey's in my coffee this morning because I was not ready
Rogge,
for that.
give me your thoughts.
I need a buzz for this conversation. My thought is this, and everything you said is spot on, and it just reminds me of the fact that we are not trading data ever about the real world. We're not trading the real inflation. We heard about transitory inflation last year from the Federal Reserve. We trade what we're told. We trade the reaction, even though you're absolutely right. There's the world of the real, and then there's our stock market.
True.
I have to remember I'm taking, what is it, the blue pill? I'm staying in the matrix. and that I think what I remind myself, in fact, my background on my desktop here is the matrix code, because I remind myself, get out of the real world, Rog. Shrink inflation. That's a British term, isn't it? If I remember, it's a British economist that coined that.
But came up with that term. It's a good term. Shrinkflation.
The bottom line is I have to trade the bonkers numbers and you're right, the new math. But at the end of the day, that's what moves the market. And you're right. It boggles the mind, but that's the game we play.
So let's bring it back. We got the PPI coming. We had CPI yesterday. And now we, even if we look under the hood and say, well, these numbers aren't real, which they probably aren't, we still have to trade the numbers that we're being told, because that is what the market will react to, is the numbers that are either miscalculated or flat out lying to us. So, Raghi, give us your thoughts here, one on yesterday's CPI data, and then two, PPI is coming in 10 minutes.
Two things I always remember. I can look at whatever expectations are. We can look at the consensus. We can look at the 4-week average or the last handful of releases. At the end of the day, the way that I position myself as a trader is I try not to guess at what's going to happen. I wait for whatever is going to happen. I look at historical volatility and say, all right, is this price action usable? Did it reach a level at which I can buy something or sell something, or is it just beyond historical volatility? And I'll wait for the next opportunity. So in terms of CPI at 8:31, I'm making a decision. On PPI at 8:31, I'm going to make a decision. So there's the part of me that is, Dennis, just like you, thinking, what on earth is the new math that goes on? How do I get that gig? How do I get that gig where I can just make numbers up? What a great gig.
That's a good gig.
That's a
We can,
good
if we
gig.
imagine our job and we can just make numbers up, we'll just make up our own P&Ls and they're real and we can just use those P&Ls. Oh yeah, I made $100,000 today day trading. I did fantastic.
That's called
just
Twitter, Dennis.
Make up
it's
stuff.
Called Twitter. It's called Twitter.
It's called
Dennis.
Twitter. That's what they do on
Yeah.
Twitter.
I want to pivot real quick here. A big complaint about this rally has been, the narrow breadth with the mega cap tech leading us the way. IWM, hey, it woke up. Nice move over the last week and a half. But financials, they're acting okay here, starting to participate in the rally. But we don't know how to integrate AI into bank stocks. So tell us, what you've seen so far into the financials and perhaps what you see in the future.
I love it, Joel. So you mentioned KRE, regional banks, the Russell. When I see the Dow and the Russell moving together, I know XLF is probably moving, our financials ETF, and regional banks, KRE, are probably moving. When they're moving together, I know I've got good harmony and likely good follow through. And finally, what is carry? 20% of the Russell. So I know that when carry gets out of the way, the Russell can start to play catch up to the big three indices. Market breadth, and I'm going to come at it from a very different way. I've been inspired by Dennis. I don't care about market breadth, never have, because if I think about the 500 stocks within the S&P, the top 14, 15 are where most of the percentage weighting is at. So that means the other 400 plus, frankly, don't matter. So when I'm looking at market breadth, we've never really needed full participation. I need participation from tech, financials, and healthcare for the S&P. Healthcare is still a bit of a dumpster fire. Financials are starting to wake up, and tech has been the engine that's been driving everything. But interestingly enough, tech XLK is weighted heavily in the NAS, in the S&P, and in the Dow. So I don't care who's participating broadly. I want to know that those players are doing what they need to do, because that's the engine, right? When I lift the hood on the S&P, I see tech, I see financials, I see healthcare.
Gold and bonds. I mean, the bond market, we've been waiting for the 134 level, is long away. We don't know what the Fed pivot is. We don't know what the information, but just talk about your positioning in the gold and the bond market.
I tell you, and this might be a little counter what we've been seeing, but if bonds like to play a game of chicken with the Federal Reserve, usually about 6 months out, right? So we're in the September contract. We can look at the DEES contract. When I look at those two, I'm thinking, like a lot of us, are we going to see a pivot in November, December? And at what point do bond yields start to fall? And right now, I'd like to get long bonds. I know it's a ridiculously tricky position because we don't know if we're going to get a rate hike in July or not. But if bonds are past July and they're thinking November, December, I'd really like to get long bonds. And if that drops the real yields, that chasm between the nominal yield of a bond and the rate of inflation, I want to get long gold too. I'm just waiting for my spot. I've sunk into it today, but we've got this grenade called the FOMC press conference at 2:30, and who knows what's going to come out of Powell's mouth.
The only problem for the bear is the silver lining market here will find a way. Even if he says a little bit hawkish, they're like, oh, he's just talking tough because the markets are up. He's not going to really be tough. We are fully in this. And again, I tweeted this out last night, Raghi, but if you were in the bear camp a month ago, you had some, you had IWM, which wasn't too far from the lows. S&P had really been kind of treading water here. Qs were in a full bull market. You couldn't argue that. But now you've got broad participation here. You have other stocks picking up the slack, value names picking up the slack, IWM coming out of its range and breaking up to the outside. It's a tough time to be a bear now.
I think the one thing that we stop talking about collectively is we don't talk about recession. And I kind of thought to myself, what's going to happen if we end up with a recession? So Powell and company hike us right into one. Labor productivity rises and it forces them to have a cut. However we take the path, it's good for stocks. And of course, we know the stock market is not the economy. So however I want to slice it, and like you mentioned, if we've got KRE on the move, that's going to help the Russell. If XLF is on the move, S&P is going to be benefited. If XLV starts participating, forget about it. We're firing on all three cylinders.
The only problem, XLV's got problems today with UNH, but that's a story for...
Why do rates always have to go up or down? Why can't they just be steady? Why can't people get 4.5%, 5% on their money? I mean, the economy's doing okay under the current situation. Everyone's speculating, pause, cut, this, that, and the other thing. What's wrong with having stable interest rates for an extended period of time as long as the economy holds in there?
Joel, what are you thinking using this kind of common sense and patience? We're in the stock market.
We need to knock the common sense out of ourselves.
What is going on? Someone check Joel. I don't know what's happened. Absolutely. But we have a twitchy monetary policy. Look at G7, G8. They can't help themselves. They've got access to levers and dials, and they've got to do what they do, and it's going to ultimately support equities. But Joel, I'm a little worried about you.
Back in my case.
I'm worried about him too.
I mean, I think we all worry a little about Joel. But Raghee Horner, Managing Director of Futures at Simpler Trading. Always great to have you on. The chat always giving you great love. Definitely give her a follow and check out Countdown Trader. Check out also the pre-market show that she does too. She has some great ones. Check them out, team. All right. Have a great one. Take care. All right. Let's get back to the action. Let's